Hey there, everyone, and welcome to this special all-mailbag edition of the Final Bar. It's Friday, August 9th. We get a lot of great questions coming to our Final Bar mailbag, and we love to occasionally take an episode and just focus on some of the great Q&A opportunities. As a reminder, a couple ways to get your questions to us. Best way is email, thefinalbar@stockcharts.com. We'll get your questions right in front of me. So anything you're running into as you're analyzing the markets, as you're trying to trade using the technical toolkit, anything on the Stockcharts platform, market dynamics, sentiment, investor psychology, it's all fair game, and we'll do our best to point you in the right direction. You can also tag us in a comment on X. Just use our handle at FinalBarSCTV. Or on our YouTube channel, of course, just drop a comment below the video that you're watching. Let's get right to question number one. Dave, do you use point and figure charts at all to identify trend reversals? You know, I occasionally get questions on point and figure charts, and I often have to just remind myself, or I guess it often reminds me how I wish I used them more often, because they're a beautifully simplistic and straightforward way to illustrate some really fantastic market dynamics. You know, if you think about normal bar charts or candle charts, they're pretty noisy, right? The day-to-day movements in stock prices are actually quite volatile, right? So you have a big, even during an uptrend, you'll have up and down days. And during a downtrend, some of the biggest up days you'll ever see are in a downtrend. So what point figure charts try to do is eliminate, or at least minimize, that noise by focusing on trend. So instead of plotting price on the y-axis and time on the x-axis like a normal bar chart, it's price on the y-axis but trend on the x-axis. So each column represents a change in trend. A column of x's is an uptrend, a column of o's is a downtrend. And Tom Dorsey, who wrote some fantastic books on point and figure charting, told me, and actually wrote a book about relating point and figure charting to football, right? When the X, when you're in a column of X's, that means the offense is on the field. When you're in a column of O's, that means the defense is on the field. And, you know, it's a great analogy if you know American football, because when the defense is on the field, so when you're in a column of O's, meaning we're going lower, that doesn't mean you can't score a touchdown. It doesn't mean the stock can't just rip to the upside all of a sudden. It's just much more common that strength is going to come during a column of X's, because that means the trend is actually constructive, right? That means the market overall is trending in the right direction. So it's reasonable to expect further upside there. So what a point figure chart does is basically chart uptrends as a column of X's, downtrends in a column of O's, and this is about a 3-minute primer on point and figure charting. It is by no means exhaustive. I'm actually using a percentage point and figure, which is kind of like using a log scale for your point and figure chart. I talked a lot with Jeremy Duplessis, who really has written some exceptionally well-received books on point and figure charting. Really, I think, moved the discipline in point and figure charting even further by using different indicators on point and figure charts and stuff like that. You know, he swears by, or he talked often about log scale point and figure charting, because the basic traditional scaling of a point and figure chart was a simplistic log scale that was just easier to do on pencil and paper back in the day. So that was a long-winded introduction. So how do you use these? So the short answer is I do use them. Do I share them on the show? Rarely. Do I have guests that talk about them? Not too often. And boy, I'll try to think about some ways that we can explore point and figure charts a little more often on Stockcharts TV and in our blogs and such. But one of the great benefits of point and figure charting is that breakouts are almost hard to miss, right? So this is a chart of Oracle, brought it up as just a good recent example. This is a classic pattern called a triple top breakout. So a triple top pattern is actually a bullish pattern. We have two columns of X's where they top out at the same level. This is a box, right? So they have the same level. And then the third one makes a new high. So a column of X's breaking higher than the previous column of X's is a buy signal. A column of O's going below the previous column of O's is a sell signal. So there's a strong buy signal called the triple top breakout. Here's a strong sell signal called a a double bottom breakdown. 1, 2 bottoms, and then this one goes below the previous column of O's. So those sell signals indicate that Oracle has rotated from a bullish phase to now more of a consolidation to now a breakdown. The other thing I like about point and figure charts, you use what are called the 45-degree lines. So you literally draw a line on the 45-degree box slope, and that really helps you identify just a simple trend analysis from a major low or a major peak to identify when the market may be reversing through that key level. So overall, I find them really fascinating. Why don't I use them? I mean, honestly, the technical toolkit is pretty broad, and there's so many things, and there's only so many things I can look at to be, in the course of a normal trading day. I would tell you that one of my favorite scans that actually one of my Market Misbehavior Premium members recently asked about, and I'm going to dig it back up, is looking for triple top breakouts on stronger than normal volume, which is actually a scan you can run within the Stockcharts platform. If you want to learn more about point and figure charts, by the way, click on the Chart School, and then we have a bunch of really good articles written about point and figure charting. I would argue that the point and figure charts that we have on Stockcharts are some of the best that I've seen, having explored a lot of different platforms out there. They're really well done. I would also tell you that if you go to Charts and Tools, and then on the right side, I think it's Sample Scan Library. Maybe that's what I'm thinking about. It's in here somewhere. I think it might be here. Let me see. Point and figure charting. Candle. Here we go. Point and figure charting. So triple top breakout, double bottom, double top breakout, and the bearish show ones as well. And there are all these other patterns, which we don't have time to talk about here, of course. But I would say running some of those scans and just seeing what names pop up, looking at the point and figure charts, looking at the regular bar or candle charts to see how they relate. That is how you can really learn point and figure charting. And by the way, if you've not checked out our sample scan library, there are so many great capabilities of the Stockcharts platform. I would say one of the great benefits of being a member is being able to save a bunch of scans, have them run automated in an automated fashion. So I have scheduled scans every day, every week. It emails me the results. It's a great way to get a platform like Stockcharts to do some of the work for you. So check it out for sure. Question number 2. How does gold react to lower interest rates and a recessionary environment? I love this question so much. And the short answer is it depends. That's the tough news. The good, or I guess the other answer is, to be honest with you, generally speaking, there's an inverse relationship between hard assets like gold and interest rates. And so I'm plotting here. And apologies for sort of a busy chart, but I'll explain what it is. The main data series here with the black bars is the gold spot rate. It's really coming from the gold futures market. So $GOLD is how you bring that up on the Stockcharts platform. You may also use like GLD, which is an ETF that tracks physical gold. They move very similar. They're almost identical. So I have no problem with using either one of those. The pink line in the background is $TNX. That's the 10-year treasury yield. So basically looking at interest rates versus gold. And you can see visually, right? When gold is going down, rates tend to be going up. When rates are coming down, gold tends to be going up. And that's that inverse relationship I'm talking about. I'll explain why that makes sense here in a minute. Now, before I call, let me explain it. So, right, why does that tend to work? Well, you think about it, right? When rates are going up, that means you benefit. You can buy bonds and get a decent, income, get a decent interest rate on that loan that you're giving to the U.S. government or wherever you're loaning your money in the form of a bond payment. So, so when rates go up, a hard asset like gold, a store of value, is less meaningful because you have other ways where you can make tons of money. But when rates are coming down and when bonds are not paying what you might want them to, something like gold tends to be a pretty good store of value. We think about it, gold really doesn't have any practical uses, right? I mean, it's used for jewelry, and people have enjoyed it for centuries, if not millennia, because it's super rare, right? So the global supply of gold is still very small relative to other minerals and other things, and people think it has value. It's pretty to look at, and people like wearing it and things like that. So, gold has value because people think it does, and that's not just a fad-like thing. That has been the case for hundreds, if not thousands of years. So gold actually tends to store value pretty well over time, and as a result, when other assets are yielding more, then gold is less valuable because you can put your money somewhere else and make a lot more money. But when rates are coming down, meaning bonds are not a great place to store your capital, why not store it in a safe haven like gold? At the bottom, I'm charting the 20-day rolling correlation between gold and the 10-year yield. And I just want to show that overall, you can see that most of the time the correlation is very low, kind of between negative 0.7 and negative 1. And that's what a strong negative correlation would be, meaning when one thing moves up, The other thing tends to be moving down. But note that in certain cases, for example, in March and April, rates were going up and gold was going up at the same time. So on shorter time frames, that relationship can actually fall apart. The reality is over time, it's hard to really attribute direct relationship between gold and interest rates. Generally speaking, again, there's been an inverse relationship, but there's no guarantee that that relationship would hold up. And a lot of times there are other factors at work. I mean, a lot of times we try to oversimplify and think, all right, if rates go up, what does that mean for gold? I like to think of those sorts of things not as hard and fast rules, but more like headwinds and tailwinds, or more like general guidelines, right? If you think about it like headwinds and tailwinds, right? It's not that you're guaranteeing that something else would go up or down. It's more just the general tendency. I think of them as tendencies, not rules. So if you think rates are going to start to come down a lot more, and here's the 10-year yield, of course, which has gone from around 4, almost 5% down to just below 4%. If you think that's just the beginning of rates going down, then based on that historical relationship, that means gold is probably going to be a pretty good place to be. And as you can see, over the last quarter, gold has been really making new all-time highs, getting above $2,500 an ounce, while rates have been coming down. So it's held up actually pretty well here, certainly in the second quarter and now going into the third quarter. So that's how I would think of that relationship. So if you think rates are going down, generally speaking, gold tends to do pretty well for the reasons that I explained earlier. Next question. I tend to buy just before pullbacks. How can I better time my entry points? Boy, great time to ask a question like that when we're sort of in prime time pullback mode for the major averages. First off, I would say there's a lot. I appreciate so much the vulnerability that is represented by your question. I think one of the toughest things for traders and investors to admit is when they're wrong, when they don't got it, right? When they don't have all the answers. Hopefully the fact that you found our channel, Stockcharts TV, that you found our platform, Stockcharts.com, that you found me and my work at Market Misbehavior. Hopefully the fact that you got there means you recognize that you don't have all the answers and you're looking to upgrade your decision making, upgrade your toolkit, and certainly we want to help you along in that journey any way that we can. So I appreciate you being honest and recognizing that there's something you're not quite getting right. When you mentioned, you tend to buy just before pullbacks, you had a much larger question that you shared with me saying that, you're often buying breakouts and it feels like every time you buy, there's a pullback right after. So while a lot of times you eventually are proven right, you sort of are underwater at the beginning and then things sort of play out. So you have two ways that you can generally fix that general problem, if that is a problem that you have. And as an example here, we're looking at Home Depot. So I'm assuming you're buying on like this kind of period, right? Where Home Depot is making a new 12-month high. So this is December of 23. We broke above the August peak. We gapped up about a day later, and then for the next 2 weeks, we're pulling back. So right here, you're feeling pretty rough because you bought here and you're underwater. So eventually you're doing fine, but it feels like you could optimize your entry point a little bit. So you have two ways you think about this, right? Number one, when you have a stock that is in an uptrend and you think that uptrend is going to continue, you can either buy strength and then, just understand that a pullback is going to happen. And obviously many pullbacks will happen in the course of an uptrend. That's actually pretty normal when a stock is going up. So you can either accept the short-term volatility or just try to optimize your entry points a little bit more. So when you see a big breakout name, when you see it making a new 52-week high, maybe put it on your watch list and wait for that first pullback. A lot of times working with institutional money managers, we were able to improve their returns over time, by looking at the same set of stocks, but just looking for pullbacks. We would always talk about buying on pullbacks, buying the dips. And if you think that a company has a good fundamental story and you're just looking for good entry points, don't buy when it's overbought. Buy when it comes out of that overbought region and it's maybe making a higher low. So you want to look for things where the longer term trend is up. So things I would look for would be, a stock trending above an upward sloping 50-day moving average, but maybe something that's pulled back in the last week. That's something you could easily create in our Stockchart scan engine. I'll look for that combination of things where the 50-day moving average is sloping upwards, but the last week has pulled back. And if you look at that set of charts that come back on the scan, you're going to find names kind of like a Home Depot, which have recently made new highs probably and are pulling back a little bit. You can also look for stocks pulling back to an ascending 50-day moving average. That's a scan that I like to look for. Look for stocks where this short-term RSI, like a 3-day RSI, is oversold, meaning it's pulled back quite a bit just in the short term, but the long-term RSI is above 50, right? So the 14-day RSI is above 50, the 3-day RSI is below 40. something like that. And I don't know if that's necessarily going to work. These are just things that are popping up in my mind. But generally speaking, I think the best idea is, don't be afraid to wait a little bit. I think a lot of times there's a FOMO, there's this fear of missing out when something breaks out. I think in terms of actually placing your bets, think about tactical pullbacks as an opportunity to build a meaningful position. Final thought on this one is, remember, it's not all or nothing. We often think about, all right, I'm buying 100% of my position, I'm selling 100% of my position. Remember, you have a lot more flexibility as a trader. So, buy 50% of the position on the breakout, wait for that first pullback, and then add the other 50%. So at least part of it you have exposure. So if there's never a pullback, at least you're participating in some way. But when there is a pullback, you're able to layer in and add to your position on the way up. So those are some ways that I would think about it. And again, the scanning engine, I think, is a really good way of trying to find and systematize that approach of looking for stocks that are in good uptrends but are pulling back in the short term. I hope that helps give you some ideas of how to improve your entry points. Finally, we've seen a number of Zweig Breadth Thrusts since 2023. Is that a good sign for stocks? I love this question. I'm giggling a little bit because I've had a number of questions about the Zweig Breadth Thrust, the Hindenburg Omen, the Titanic phenomenon, Copic curves. These are great sort of broad market indicators that tend to come up when they show signals, and other times they don't, and that's totally fine. And that, I guess that's the first way to answer your question. Something like the Zweig Breadth Thrust, you have to remember that technical indicators like MACD or moving averages, they kind of always have a signal, right? MACD is always giving you either a buy signal or a sell signal. It's meant to sort of track the trend up and down and really give you actionable turning points all along the way. Something like the Zweig Breadth Thrust or the Hindenburg Omen or the Copic curve, they actually signal very rarely. As a matter of fact, I'm looking at our main Zweig Breadth Thrust indicator, which we've coded on Stockcharts. You can see the ticker here if you want to create the chart. And actually, I'll include the link to this chart in the comments, so you can incorporate it into your own Stockcharts login if you like. But this ticker right here gives just a binary indicator. We have a series of indicators that are just a binary, basically 0 to 1, and it goes to 1 if it's a valid signal, and most of the time it's at 0. And it's really intended for you to overlay it on top of the price. So I'm showing here, going back to 2000 on the daily chart of the S&P 500, all the Zweig Breadth Thrusts that at least we've used using the methodology coded in that indicator. 1, 2, 3, 4, 5, 6, 7, 8. So 8 times in 25 years is pretty rare, right? So averaging once every couple years, essentially 3 years or so. So we've had a number of these, right? You had one at the end of Q1. This is the beginning of March of 2023. You had another one sort of October, November of 2023 after the major market low. So look back in the top here and you'll notice when these signals tend to happen. It's after we've had a pretty good pullback. And that's something to remember. The idea of a breadth thrust, not just Marty Zweig's version, but the broader treatment of breadth thrust is essentially when breadth is very negative, meaning things generally speaking are going down, and then you have a big thrust higher in breadth. So what that means is kind of everything's selling off, and then all of a sudden you see a bunch of buying coming in, and it propels stocks much higher in a very short period of time. And that is essentially what Marty Zweig did, who was a strategist decades ago, very popular. His comments were market moving in the at his peak. And essentially, he's using an exponential moving average of advanced decline data. And you can see, if you click on the little magnifying glass and search for Zweig Breadth Thrust, you can see some articles that explain in a little more detail exactly what this indicator is doing. And essentially, when the breadth is very negative, and so on this indicator, it goes below 0.4, and then within 2 weeks, within 10 trading days, it goes above 0.63, I think is what the number we're actually using. It might be 0.62. I forget what exactly the number is in the indicator. Within 2 weeks, that gives you the buy signal. So breadth is very negative. Everything's going down in 2 weeks. Breadth becomes incredibly positive. And what that usually happens, that usually only happens after the market has been going down, and then you get this big breadth thrust, meaning a bunch of things go higher, which indicates a bunch of investors are allocating to equities and buying and pushing the prices up. And usually afterwards, if you look at the performance to the right of those breadth thrust indicators, I mean, maybe 2004, we made a new swing low a couple weeks later, but pretty much every other one of the time, it ended up being a nice run soon afterwards. And that's why people pay attention to the Zweig Breadth Thrust. And again, it's not signaling right about now. We did almost get down there. I'm going to go to a very short term. See, last year, I don't think we quite got to 0.4. We might have just ticked it to the penny. I'll have to check the tape on that here recently. But essentially, you can see what's happened, right? We go below that level, and then we go above the red line, 0.62. Same thing here. We go below, and then within 2 weeks, we go above. And that happened in April of 23, in November of 23. And so if we would get more of a protracted decline here in August and September, you will hear me talking about the Zweig Breadth Thrust indicator a lot more often, because it's really designed to pinpoint that new entry, not necessarily pinpoint a low, but recognize when we have the all clear that usually happens after there's that much of an influx of buying power on the particular markets. And again, I'll put a link below to access that chart if you want to dig into it a little bit further, as well as an article to learn more about the Zweig Breadth Thrust. That's it for now, folks. Thanks so much for asking those thoughtful questions. I hope these answers helped you think a little bit about how the technical analysis platform and how technical analysis toolkit and how the Stockcharts platform can help you improve your decision making. Please keep your great questions coming. The final bar at stockcharts.com is the way to get them to us. For Stockcharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great weekend.